Welcome to ValueVest Daily. You know, if you're a value investor looking at this market, you've got to feel like you're walking on a tightrope. I mean, on one side, you've got the Federal Reserve, the Fed itself, waving these huge red flags about crazy high valuations. And on the other side, a geopolitical powder keg in the Middle East that looks like it's about to go off. So today, we're not going to just talk about the fear. We are giving you the actual survival guide for 2026, what to sell, what to buy, and exactly how to shield your portfolio. Let's get right into it.
So the date on the calendar reads February 22nd, 2026. And the warnings out there, well, they're not whispers anymore, they're screaming.
The market's fever has just hit a really critical number, 40.
And historically, a number like that has meant only one thing. We are right on the brink.
And all it's going to take is one single spark. All right, before we jump into the playbook, you know the drill, our mandatory disclaimer. This is for educational purposes only. It is not financial or tax advice, so please do your own homework. Okay, with that out of the way, this combination of sky-high valuations and a geopolitical shock is, it's the classic recipe for a major market correction. But for value investors who are prepared, this isn't a time to panic. No, this is a time for opportunity.
Okay, first up, let's really dig into the numbers that have the Federal Reserve sounding the alarm. And look, this isn't just some pundit speculating from the sidelines. These are warnings coming from the very institution at the absolute center of the financial world. They're looking at this market and seeing basically zero margin of safety.
So the key metric we got to talk about is the Shiller CAPE ratio. Now, for anyone who's not familiar, this is not your normal P ratio. You know, a standard PE can be kind of misleading. It can look cheap after one great year or super expensive after a bad one. The CAPE ratio is way smarter. It looks at the average earnings over a whole 10-year period, and it adjusts for inflation. This smooths everything out, all the booms, all the busts of a business cycle, and it gives us a much more reliable long-term picture of where the market's valuation truly is. It's the gold standard for a reason. Now check this out, because this is where it gets really interesting. Look at where we are right now. The CAPE ratio has just crossed 40. To put that into perspective, this level has only been beaten once in modern history. And that was right at the absolute tippy top of the dot-com bubble in 2000, just moments before that epic crash. We are now more expensive than we were at the peak right before the 2008 financial crisis. This is some seriously thin, dangerous air we're breathing up here.
So what does a CAPE ratio of 40 actually mean for your money? Well, history is painfully clear about this. When the CAPE gets this high, anything over 35 really, the average returns you can expect for the next decade just plummet. They fall to just 1 to 3% per year. That is a tiny fraction of the long-term average of 7 to 10%. So here's the takeaway. Buying into the broad market at these levels is, historically, a bet on a decade of going absolutely nowhere.
And hey, if you think this is just our analysis, think again. This really brings the point home. The Fed chairman himself, Jerome Powell, he recently said, in his very careful, understated central banker speak, that equity prices are fairly highly valued. Let me tell you, coming from a Fed chair, that is the equivalent of screaming fire in a packed theater. And the last piece of this valuation puzzle is in the credit market. So these things called credit spreads, that's just the extra interest investors demand to hold riskier corporate bonds instead of super safe government bonds, they're down to just 71 basis points. That's 0.71%. It's the lowest they have been since 1998. In simple terms, this means investors are so unbelievably confident that they see almost no difference in risk between a company's bond and a U.S. government bond. That's not caution, that is pure unadulterated complacency. A market this fragile is just waiting for a shock. A market this complacent is like a dry tinderbox just waiting for a match. And that spark, well, it might be igniting right now in the Persian Gulf, with tensions between the United States and Iran escalating fast.
And look, these aren't just scary headlines. These are facts on the ground. Right now, there are not one, but two U.S. aircraft carrier strike groups sitting in the Gulf. That is a massive show of force. This is actually the largest American military buildup in the region since the 2003 Iraq invasion. And how's Iran responding? By provocatively shutting down the vital Strait of Hormuz for what they're calling drills. Meanwhile, diplomatic talks have completely stalled, and intel reports are suggesting U.S. leadership is seriously considering military strikes within days. This is not some hypothetical risk. This is a crisis unfolding in real time.
So why does a fight in this tiny little waterway matter so much to everyone? Well, this chart says it all. The Strait of Hormuz is the choke point for 20% of the entire global oil supply.
1 out of every 5 barrels of oil in the world flows through that narrow pass every single day. Any disruption, let alone a full-on war, sends an immediate and violent shockwave through the world's energy markets. Okay, so here's the crucial part: how this all connects back to that overvalued stock market we were just talking about. It's a direct and, frankly, a predictable chain reaction. First, a disruption in Hormuz makes oil prices spike. We're talking 20% or more maybe in just a few weeks. We have seen this movie before. Second, higher oil prices mean higher inflation, right? It hits everything from the pump to shipping costs. Third, rising inflation forces the Fed's hand. They can't cut rates, they might have to pause or even start hiking rates again to fight it. And fourth, and this is the killer, higher interest rates are absolute poison for those high PE growth stocks that have been leading this market. Their whole valuation is built on a promise of future earnings, and higher rates just make those future earnings worth so much less today. So the very stocks that are the most expensive, they get hit the absolute hardest.
Okay, so we've got an expensive market and we have a very clear trigger. Yeah, it sounds pretty bleak, but this is where value investors thrive. It's time to pivot from playing defense to playing offense. So here it is, the actionable playbook to build your financial fortress for 2026.
Here you go, the entire strategy on one slide. It's a simple 5-step process. First, we trim the fat. Get rid of the most expensive, most crowded trades in the market. Second, we take that capital and we rotate it into real, tangible value. Third, we build up a nice cash position. Fourth, we diversify away from the US market. And fifth, we add a classic crisis hedge. We are going to walk through every single one.
Step 1 is probably the most important. Reduce your exposure to the market's darlings. The Magnificent Seven, all those other high-flying tech stocks, they've had a mind-blowing run, but they are the absolute epicenter of this valuation risk. And like we just saw, they are the most vulnerable to a spike in interest rates caused by an oil shock. The playbook here is crystal clear. Trim your total exposure to that group to less than 15 or 20% of your whole portfolio. This isn't about selling everything. It is about smart risk management.
Now, step 2 is where the real opportunity is. We take that capital from trimming those expensive growth stocks and we rotate it. We are not running to cash and hiding under the bed. No, we are actively buying cheap, durable businesses. We are on the hunt for cash flow machines that don't just survive chaos, but can actually benefit from it.
So where is this real value hiding today? Well, first, the big energy companies. In a world freaking out about oil shocks, they are the direct beneficiaries. And they're trading at dirt-cheap multiples, like 9 to 11 times earnings, while paying you these fat 4 to 6% dividends just to wait. Second, defense and aerospace. Sadly, global tension is good for their business. These companies have record backlogs. And third, quality small caps. I mean, the small cap index has been left for dead, and you can find tons of solid businesses trading at a 15% discount or more to their fair value. These are the pockets of the market where that margin of safety still exists.
Now for the final 3 steps, and these are so crucial for defense and for setting up long-term opportunities. Step 3, hold 10 to 15% of your portfolio in cash or short-term treasuries. Think of this as your dry powder. When the panic selling starts, cash is king, and it gives you the firepower to swoop in and buy great companies at fire-scale prices. Step 4, go global. The valuation problems we've been talking about, they're most extreme right here in the US market. International and emerging markets offer much more reasonable valuations and give you essential diversification. Plus, they could get a nice tailwind if an oil shock weakens the US dollar. And finally, step 5, add a hedge. In a world of rising inflation and geopolitical fear, assets like gold and gold miners historically do very well. They're the classic safe haven, and we're already seeing them start to move higher, which tells you that smart money is getting prepared for turbulence.
So let's bring it all together. The bottom line is this. The Federal Reserve is telling you, loud and clear, that the market is dangerously expensive. The crisis in Iran is providing the exact kind of trigger that historically pops these bubbles. And the value investors who have the courage to rotate out of what's popular and into what's cheap now are going to look like absolute geniuses in 12 months.
Okay, now I want to hear from you. What's your biggest portfolio worry right now? Drop it in the comments below. Are you more worried about being overexposed to those pricey tech stocks? Or are you worried you don't have enough exposure to real assets like oil? Let me know. I read every single comment.
If this breakdown helped you see the market a little more clearly, please do us a huge favor. Hit that subscribe button, give this explainer a like, and share it with someone. It really helps us bring you these daily learning opportunities before you put your hard-earned money to work. And one more thing.
Please drop a comment if you want us to deep dive into any specific high-risk, high-reward opportunities. In a market like this, fortune favors the prepared. Stay disciplined, stay value, and we'll see you in the next